Your mortgage lender has something called a due on sale clause. And if you transfer your property into an LLC, they have the legal right to call your entire loan due immediately. If you own rental property in your personal name and you're thinking about moving it into an LLC for asset protection, there's one massive problem you need to understand before you do anything. Specifically, this means they can demand that you pay off the full mortgage balance right now. And if you can't, they could foreclose on your property. But here's the thing, thousands of real estate investors transfer properties into LLCs every single year without triggering this clause, and there are specific strategies you can use to protect yourself legally while minimizing the risk with your lender. You also need to understand whether you should form your LLC in the state where you live or where the property is located, whether each property needs its own LLC, and whether you actually need a holding company structure for anonymity and asset protection. So as someone who has already helped thousands of entrepreneurs structure their real estate holdings properly, and as the founder of LLC Toolkit Pro, a platform that helps you form LLCs, I want to walk you through exactly how to move your rental property into an LLC without screwing up your financing. So let's go ahead and jump in. Okay, so let's start with the biggest risk you face when transferring a mortgaged property into an LLC, which is the due on sale clause. And I want you to pay attention here because this can literally cost you your property if you handle it wrong. So first of all, almost every mortgage in the United States includes a due on sale clause. This clause says that if you transfer ownership of the property to another person or entity, the lender has the right to demand immediate payment of the entire loan balance. Why? Because when you got your mortgage, the lender approved you personally based on your credit, your income, and your assets. If you transfer the property to an LLC, the lender now has a different borrower, and they didn't agree to that. Now here's the reality. Most lenders don't actively monitor for LLC transfers, and many investors successfully transfer properties without the lender finding out or caring. However, that doesn't mean it's risk-free. If your lender does discover the transfer, they can call the loan due, and if you can't pay it, you could lose the property. So what should you do? The safest approach is to contact your lender before transferring and ask for permission. Some lenders will allow the transfer, especially if you provide a personal guarantee. Others will refuse. But at least you know where you stand and you're not violating your loan agreement. Now here's one that surprises many of my clients. If you're buying a new rental property, get the mortgage in the LLC's name from the start. This avoids the transfer problem entirely, although you'll likely need to personally guarantee the loan anyway. So let's talk about which state you should actually form your LLC in if you own rental property. And the answer might surprise you. So first of all, if you own rental property, you should form your LLC in the state where the property is located, not the state where you live. Why? Because if you form your LLC in a different state, you'll need to register it as a foreign LLC in the state where the property is located anyway. This means you'll be paying fees in 2 states instead of 1. For example, if you live in California and you own a rental property in North Carolina, form your LLC in North Carolina. If you live in California and you own rental properties in both Texas and California, you'll need separate LLCs in each state. Next, let's talk about privacy and anonymity. Many investors want to form their LLC in Wyoming or New Mexico because these states don't publicly list member names. But here's the problem. If you own property in California and you form a Wyoming LLC, you still have to register that Wyoming LLC as a foreign LLC in California. And California will require you to disclose ownership information anyway. So the anonymity benefit is mostly lost. The only way to maintain true anonymity is to use a holding company structure, which we'll talk about in a moment. But for most investors with 1 or 2 rental properties, just form your LLC in the state where the property is located and keep it simple. Now, with all of that said, you're probably wondering, Should I put all my rental properties into one LLC, or should each property have its own LLC? So let's talk about it. So first of all, the best practice is to put each property into its own separate LLC. Why? Because if someone sues you over one property, they can only go after the assets in that specific LLC. If you have multiple properties in one LLC and you get sued, all of those properties are at risk. Next, there's another benefit that most people don't know about. When each property is in its own LLC, you can sell the LLC itself instead of selling the property. This can help you avoid real estate transfer taxes and fees in some states because, technically, the property didn't change hands. Only the ownership of the LLC did. Plus, having separate LLCs makes it cleaner if you have partners or investors on some properties but not others. Each LLC can have its own operating agreement and ownership structure. Now, here's the important part. This doesn't mean you should use your IT consulting LLC for your rental properties. Never mix business activities in one LLC. Your consulting business should be in one LLC, and each rental property should be in its own separate LLC. Mixing them defeats the purpose of asset protection. So let's switch gears here for a little bit and talk about whether you actually need a holding company structure. And the answer is it depends on your situation. So first of all, a holding company structure works like this. You create a parent LLC or holding company in a privacy-friendly state like Wyoming. Then you create subsidiary LLCs in each state where you own property. The holding company owns all the subsidiary LLCs, and your name only appears on the holding company, not on the property-level LLCs. This structure gives you anonymity because the public records for each property will show the subsidiary LLC as the owner, not you personally. And the subsidiary LLC is owned by the Wyoming Holding Company, which doesn't publicly disclose member names. Next, this structure also provides an extra layer of asset protection. If someone sues over one property, they can only reach the assets in that property's LLC, not your other properties or the holding company itself. However, here's the reality. This structure is expensive and complex. You're paying annual fees in multiple states. You need separate accounting and tax filings for each entity, and the setup costs can be high. For most investors with just one or two rental properties, this is overkill. Now, usually when clients start calling me to help them is when they have 3 or more rental properties, and they're serious about building a portfolio. This is when the holding company structure starts to make financial sense. Now, at the time of this video, thousands of real estate investors are successfully using LLCs to protect their rental properties and build wealth. But you need to do it the right way. Remember, there are no tax benefits to holding property in an LLC versus your personal name. The only reasons to use LLCs are asset protection, anonymity, and easier selling of properties. If you have a mortgage, understand the due on sale risk. If you own property in multiple states, form separate LLCs in each state. And if you're serious about building a portfolio, consider the holding company structure. Now look, forming an LLC yourself is very stressful. And as someone who has formed LLCs for most of my businesses, I won't recommend the DIY approach. But use LLC services. All you need to do is avoid overpaying for any services. Make sure to use our LLC cost calculator. The link is inside the video description. Thank you for watching.